All right, so basically, as far as like a summary of the bookkeeping end of it, everything boils down to this accounting equation. Assets equals liabilities plus equity. And so it's a bookkeeping system that was established as a way to record transactions, right? And so if you think of a company, and this would be a solvent company that wasn't going bankrupt because their liabilities were in excess of their assets, but a solvent company, and we consider these would be all of the assets, if this represented all the assets. We can think of that in pieces. So this piece, let's say this is the liability piece. So that's the piece that, what would you say, what is the liability piece?
Debt.
Debt, yeah. So of these assets, creditors are saying, we have debts on this amount. Now, not specifically, unless contractually they do, they could, right? They could have an agreement that contractually ties it to specific assets, but in general, they loan money because that company has assets. And so then the piece that's left is who? Yeah, and whose is that?
The owners.
Owners, yeah. So if you have a lot of debt, there could be, quite a bit of that is owed to creditors and maybe just a little bit left for the equity. And so there's a whole balancing between how much debt, how much equity should we have. And a lot of that you would cover in your finance classes. How do we discover and test what is the best balance?